7. Indian Overseas Bank, good people to grow with.
Hello and welcome to Bloomberg Quint. You're watching the Fine Print. Remember back in school, how you arrived at an answer for a maths problem was as important as the answer itself? Well, starting this year, the audit world will have to go back to the school ways. The means will be as important as the end. Now, all of this build-up is to ease you into a conversation on a new auditing standard. It's called Key Audit Matters, and starting this year, it will make its way into the financial statements of listed companies. The standard promises to give investors and shareholders information on areas that required significant auditor judgment. Now, what this means and how can investors make use of this information? To answer that, I have with me Jamil Khatri, partner at BSR & Co. Jamil, welcome to the Fine Print. Jamil, the ICAI had first issued this standard, which is we are referring to as Key Audit Matters, back in 2016, but its implementation was delayed, I understand, because it was felt that the profession wasn't ready. I want to take a step back and first try and understand what prompted the Institute to put out this standard and what lacunas currently exist in audit reports that this standard is seeking to fill.
I think the basic problem that this is trying to solve is, if you look at the format of the audit report today, it's a very simple pass or fail audit report. So either the auditor gives a clean audit opinion or the auditor gives a qualified audit opinion to say they're not happy with something. But a lot goes into the audit beyond this pass and fail. And while there's a lot of communication between the auditor, the audit committee, the management on some of the matters that go behind an audit, investors and external stakeholders never have a full lens on that. Sure. So the feeling that was felt, and this is not just in India but globally as well, is could the audit report convey what are the close calls, what are the judgment areas that the auditor focused on before they got satisfied with the financial statements that are being presented. And that resulted in this concept of Key Audit Matters, which is, as I said, not just an Indian phenomena, but a global phenomena.
Okay. So when I'm looking at, let's say, the audit reports that will start coming out from, let's say, next month onwards, I'm just talking about a little bit of format here to give the viewers an understanding on how it will appear in your audit reports. So there is qualification, which is, some of the matters that get qualified. Then there is emphasis on the matter. And then this will be a separate section in audit reports?
That is correct. And it's important to understand the distinction between the three from an investor's perspective, any reader's perspective. A qualification is an area where the auditor is saying that they are not comfortable with what is being represented in the financial statements, so they don't agree. An emphasis is an area where the auditor agrees, but they believe there is significant uncertainty. Let's say in the case of a litigation or a tax case, where their judgment is based on the way things stand today, but if things were to change, then the auditor is asking the investors and the readers to be mindful of that when they read the financial statement. That's an emphasis. A key audit matter says that while the auditor does not believe there is such a level of uncertainty and does not disagree with management, but it's important for the investor to understand what went behind the audit. What were the judgment areas where the auditor spent a lot of time with the audit committee and areas which were most significant to the audit, which is being called out to the key audit matters. So it's a different category from a qualification and an emphasis for matter.
Okay, so then let me quickly come to what sort of issues can feature under this section called Key Audit Matters. The standard defines it to mean those matters that in the auditor's professional judgment were of most significance in the audit of the financial statements of the current period, and these areas are selected from the matters communicated with those charged with governance. I'm guessing it means audit committees. Give us a flavor of what issues are likely to get featured under this section.
Sure. So as you correctly pointed out of the areas that are discussed and debated with the audit committee, there are certain areas which would have required a lot of attention on the part of the auditor, and which the auditor feels are most significant. Typical examples in our experience would be impairment. So if there is an acquisition, there is a goodwill, a lot of estimates are made by management in relation to supporting why that goodwill can continue to be on the financial statement. So that would be an area. Tax provisions is typically an area because there's significant uncertainty, and tax for most companies tends to be a big component as far as the earnings are concerned. Another area would be, and some of the areas are sector specific. So for example, if there's an automotive company, there could be a discussion on research and development expenditure to determine what is capitalizable and what is research which has to be expensed, and what went behind the auditor's thinking to get to the right answer. So typically areas that are material to the financial statements and involve significant judgment on the part of both the management as well as the auditor.
Okay, so let me delve a little deeper into these examples that you mentioned. What would you typically say when you're talking about impairment, or when you're talking about R&D expenses? What is it that you're trying to communicate to the investor there?
Sure. So the key thing is to highlight to the investor what are the significant judgments that go into reporting a particular number in the financial statements. So let's take the area of research and development. In the area of research and development, the key question is when the company is incurring certain activities, incurring certain cost on activities, should they charge it to the profits or should they capitalize it as a development expenditure? So that's the judgment call. That depends on at what stage of development is the product. So what the auditor is trying to highlight to the investor is that there are certain expenses where management has crossed the line on what they believe is development, and therefore they're not charged to profits but are being shown in the balance sheet as development expenditure. The auditor also wants to highlight what did they do to get that comfort. So for example, they may explain that because this is an area where the basic technology is well developed, or management has shown plans for development, that is what the auditor looked at to satisfy themselves. The auditor may call out the past experience of the company to say how the company has been successful in terms of taking products to development and commercialization. And from an investor's perspective, what this does is make the investor is reading the financial statements and evaluating the company based on a set of parameters. So they then can determine, is this consistent with the way they've understood the company, what management has told them, and therefore is the whole thing stacking up.
Okay, so as I understand, you're not doing anything new here. It's perhaps what was behind the scenes all along is now sort of coming out in front of the public and, you know, investors, etc. The conversations that you have with audit committees, do you think that those are likely to change as a result of this requirement now?
Yeah, I think that's a very good question. And I think that is where I think overall quality of reporting is likely to improve the most. The way I've always kind of seen this is there are three pillars of good reporting and good corporate governance in this area. One is, of course, the management and the integrity with which the management prepares the financial statements, the audit committee and the rigor with which they challenge the management in this area, and the audit and the skepticism that the auditor demonstrates in challenging both the management and to some extent the audit committee. In the past, for a variety of reasons, if there were a lot of issues coming up in the audit committee may not really know, given time constraints and involvement, on what to focus on. But once the auditor said, hey, out of these 10 areas, I want you to know these 4 areas are the areas where I exercise the most judgment and which are most significant to the audit, our expectation is that audit committees will start focusing and diving deeper into those areas, and that may therefore result in better reporting.
Okay, I do want you to give me a little more, a few more illustrations on industry-specific sort of concern areas that, you know, auditors are likely to look at, and how can investors use this information from the audit reports as they start coming out?
Sure. So let's take another example of a construction company, a large engineering construction company. One of the key areas for them would be revenue recognition and application of what is called the percentage completion method, which means out of the total contract value, how much are you recognizing in profits and revenue in the current period? This area is inherently very judgmental because it involves two big estimates. One, what are the total costs you incurred on the project till date? And second is, what is your estimate of the total cost that you will incur on this project till completion? What this will do is this will result in a very good amount of challenge for the audit committee to understand what are the controls and processes that the company has in this area, and therefore make sure that any gaps that existed in that process are being challenged in the right manner. So as you correctly said, I don't think this is about the auditor doing more, but with the collective wisdom of the audit committee, the auditor, and highlighting that to investors, the rigor around some of these things is likely to go up.
Okay. How can investors use this information, Jamil? Would you advise that, let's say, an investor, and I'm just using names for illustration purposes here, would you advise that within a sector, I sit with several reports or several audit reports, and I don't know how many investors will go through that rigor, but would it be advisable to sit with several audit reports of, let's say, Infosys, TCS or Wipro in the IT sector, and then probably gauge for myself the areas which are problematic across the sector, which auditors have drawn attention to, or then specific companies? How do I make that judgment call as an investor when I'm looking at different companies within a sector?
I think that's two approaches I would suggest. One is, it will be good to do it the way you kind of are putting out, because it will give investors understanding and comfort that they have considered all the issues which are critical to understanding the financial statements. Another lens could be to look at what is it that is sticking out for a particular company. So let's say, if in your example, if 3 IT companies have disclosed certain things, and there is another area which is coming only in one company, for example, that may mean that there is something which has to be looked at, which is very company specific in that case as well. And then it all depends on, has that any sensitivity in that area of something not working out per plan, has that been factored into the models that investors have kind of weaved in? So I think, coming back, this is to give investors a better, deeper inside lens into the companies and the financial statements, and that's what they should be looking out for.
Okay. Jamil, any such move towards better disclosures or transparency, we've historically seen end up becoming boilerplate or templated discussions. Will this new feature in audit reports likely to meet the same fate? And if not, then what is the kind of language that you're using? Because already you must be working on some of the reports that will start coming out for this financial year. What is the language that investors are likely to see? And are you making an attempt to not make it boilerplate or templated, as opposed to more meaningful and useful discussions?
Yeah, again, it's a very good challenge. I think if the idea is to give investors and other stakeholders a better lens, it's very important that auditors avoid very technical jargon language. And therefore, what we are recommending to our people, and there's a lot of training and awareness we are trying to create internally amongst our partners and our teams, is how do you communicate the message in a language that the external world can understand? So just as a very simple example, we use a term called cutoff. Now, nobody other than accountants probably knows what cutoff means, and very simply that means recognizing sales in the correct period and not recording it earlier. So we would never use the word cutoff while explaining revenues. We will hopefully, when we present key matters, start talking about how have we ensured that sales are not reported earlier or are not deferred beyond the period in which they need to be recognized. At a broader level, there is always a risk that something like this becomes boilerplate, and my advice to regulators would be to look out for this. I'll give you an example. When management discussion and analysis, or MD&A, was introduced for the first time in the United States, and as it evolved, the Securities and Exchange Commission found that people were using very boilerplate language to explain their business risk, business performance, and the SEC started focusing in that area and started challenging management to say, are you really describing the risk in your business? And over time, that area has seen a very significant improvement. I was with a leading investor who invests globally, a firm, and they said that when they read a 20F or a 5 or an F1 or for an American company, they can understand the whole business and the performance reading that one document. I think that is the challenge we should set for ourselves.
Okay, all right. Maybe I'll come back to you next month when some of these reports start coming out. Final question, Jamil. Will investors also find information on unlisted subsidiaries, because this current auditing standard will only apply to the listed universe? Will I also find key risk areas or key areas where you had to exercise judgment of the unlisted material subsidiaries as well, probably?
That is correct. The way this will work is the auditor of the main listed company in this example will continue to rely on the audit work done by the auditors of the unlisted company and see how best they can report to the main auditor what are the key audit matters affecting the operations in your example of this unlisted subsidiary. If any of those areas are material enough and important enough to the consolidated financial statement, then it is the responsibility of the main auditor to bring that out, referencing that that's been kind of audited by another firm. So yes, you will see information about unlisted material subsidiaries to the extent they are important and significant to the consolidated financial statements.
All right, Jamil, we'll leave our first conversation on key audit matters, but I do promise to come back and talk to you once we have a little more sense of the kind of language and the explanation that auditors are giving investors. Thank you for joining us here on the Fine Print, and thank you so much for watching.